IAS 16 Property, Plant and Equipment establishes the accounting principles for recognizing, measuring, depreciating, and disclosing tangible non-current assets used in business operations. Within the DIP-IFR syllabus, this standard is fundamental because property, plant, and equipment, PPE, often represent significant investments that directly affect financial position and profitability. IAS 16 requires entities to recognize PPE when future economic benefits are probable and the asset's cost can be measured reliably. Initial cost includes purchase price, import duties, non-refundable taxes, directly attributable costs, and dismantling obligations. For self-constructed assets, costs include materials, labor, and directly attributable overheads. Expenditures such as routine maintenance and administrative costs are generally expensed rather than capitalized because they do not create future economic benefits. Borrowing costs associated with qualifying assets are addressed through IAS 23 borrowing costs and are closely linked to PPE accounting. Borrowing costs may be capitalized when they are directly attributable to the acquisition, construction, or production of a qualifying asset that takes substantial time to prepare for intended use or sale. Examples include manufacturing plants, infrastructure projects, and self-constructed buildings. Capitalization begins when expenditures are incurred, borrowing costs are incurred, and construction activities are underway. Capitalization ceases when the asset is substantially complete. Borrowing costs unrelated to qualifying assets are expensed immediately. This treatment ensures that the cost of PPE reflects all directly attributable expenditures necessary to bring the asset into operational condition while avoiding inappropriate inflation of asset values. IAS 16 also distinguishes between capital and revenue expenditure in subsequent accounting periods. Subsequent expenditures are capitalized only if they improve the asset beyond originally assessed performance standards or extend useful life significantly. Examples include major upgrades, replacements of significant components, or substantial efficiency improvements. Routine repairs and maintenance, however, are recognized as expenses because they merely maintain existing operating capacity. The standard also requires component accounting when assets contain major parts with different useful lives, such as aircraft engines or building roofs. Each significant component must be depreciated separately over its own useful life. This approach improves accuracy in depreciation calculations and ensures that financial statements reflect the consumption of economic benefits associated with different asset components more faithfully. After initial recognition, entities may choose either the cost model or the revaluation model for measuring PPE. Under the revaluation model, assets are carried at fair value less subsequent depreciation and impairment losses. Revaluation increases are generally recognized in other comprehensive income and accumulated within revaluation surplus in equity, unless reversing previous decreases recognized in profit or loss. Revaluation decreases are typically recognized in profit or loss unless offsetting prior surpluses related to the same asset. Revaluations affect depreciation expense because future depreciation is based on the revalued carrying amount. This model improves relevance by reflecting current asset values but also introduces volatility and requires reliable fair value measurement. Accurate accounting for revaluations is therefore essential for transparent financial reporting. The disposal of revalued assets requires careful accounting treatment to ensure proper recognition of gains, losses, and revaluation reserves. Gains or losses on disposal are calculated as the difference between disposal proceeds and the asset's carrying amount at the disposal date. Any remaining revaluation surplus associated with the disposed asset may be transferred directly to retained earnings but is not recycled through profit or loss. Depreciation calculations for revalued assets must also reflect revised carrying amounts and remaining useful lives. Component depreciation becomes especially important when major asset parts are replaced or derecognized individually. These requirements ensure that financial statements accurately report asset consumption, disposal outcomes, and changes in equity while maintaining consistency with IFRS principles and enhancing comparability between reporting entities. IAS 20 government grants and IFRS 5 non-current assets held for sale introduce additional reporting considerations linked to property, plant, and equipment. Government grants related to PPE may be recognized either as deferred income or deducted from the carrying amount of the asset. Grants are recognized systematically over periods, benefiting from the related asset use. IFRS 5 requires non-current assets to be classified as held for sale when recovery is expected primarily through sale rather than continued use, and when sale is highly probable within 12 months. Held for sale assets are measured at the lower of carrying amount and fair value less costs to sell, with depreciation ceasing upon classification. These standards ensure that asset valuation reflects expected recovery methods appropriately within financial statements. Investment properties are accounted for under IAS 40 and differ significantly from owner-occupied properties covered by IAS 16. Investment property refers to land or buildings held primarily to earn rental income or benefit from capital appreciation rather than operational use. Unlike ordinary PPE, investment properties may be measured using either the cost model or fair value model. Under the fair value model, gains and losses arising from changes in fair value are recognized directly in profit or loss rather than other comprehensive income. This treatment can create earnings volatility but provides more relevant information about market value changes. Overall, the DIP-IFR syllabus requires candidates to understand how IAS 16, IAS 20, IFRS 5, and IAS 40 collectively govern the recognition, measurement, depreciation, revaluation, and disposal of non-current tangible assets within international financial reporting.